Everybody. Today, let's discuss a question that I get asked by a lot of my friends, my families. They are in trucking industry, they are in construction industry, they they work as subcontractors in other industries. They call me and ask me, should I incorporate my business or not? And they want to find out, how much money am I making when I should think about start making incorporating my business. And there isn't really an answer for that. It really depends on what your plans are, how much money you're making, if you have plans of growing your business or not, you have plans of selling your business. So let's get to it. Pro number one: reduces risk of liability. It's important to remember that it does not eliminate liability, but in some cases it reduces it. They want to know that if they go to the bank, that they can get loans from the bank just on the business. That's not true. Initially, so government of or CRA, Incorporation Canada, they treat business as entities. It's a non-living person. So, and the banks treat them the same way. Initially, when you go to the bank and want to get a loan on your incorporation, a newly incorporated business, you can't get a loan. There's no credit history. The banks don't know. They don't have reliable data on your sales. You can definitely present them with a business plan, but they don't know your business, so they will never give you loan just based on the business. So they will give you a loan they will need some kind of personal guarantees. Your personal home, your personal asset will be on the line. So for people who think that right away, they'll get a loan, and if they can't pay it back, they won't have to worry about it. That's not true. Your personal guarantees will have to be given initially. But as your business grows, as your business builds more credit, you will see that banks are more comfortable to handing out loan to your business. Eventually you'll be able to either eliminate personal guarantees altogether, or you can reduce your personal guarantees in some instances. But there's always, for example, somebody in accounting, we provide service. There's a liability involved in providing services as well. Some products, there's a liability on the products too. So it's best to talk to your lawyers to find out, all the liabilities that business you're running can run into. You're driving a truck, you're driving a gravel truck, you're doing construction. There's liability involved. If the house falls down, and then this unfortunate incident and you kill somebody, there's liability involved. So you have to find out all the liabilities that could affect your business and make sure that you're protected. Number two is, this is one of the bigger ones. It's a little bit hard to people to understand. Not a lot of people know about it. It's something called lifetime capital gain exemption. For example, most of the times business, us accountants, what we do is we look at the incorporation when the business is incorporated. Normally it's around $600 for incorporation costs. We take $100, and that's what we tag on to the share capital. So your business initially you own is for only $100. But when, let's say you have run your business for 10 years, 15 years, now your business is worth $1 million. You want to sell your business for $1 million, and you get to sell your business for $1 million, but the first $900,000 you can they're tax free. So you can trigger something called lifetime capital gain exemption, which is, I believe, close to $900,000 right now, and you will only be paying taxes on the $900,000, on the $100,000 minus the $100 that you initially put in. So some people use it and they grow their business and they sell it and they get some money tax free. So I have a client who his intention was that he does not care about taking money home. He has a business, he wants to grow it, as much as he can, but he wants to use that money and put it back into the business. So if you're making too much money, and and all of that money is going on to your personal tax return, it's good to start incorporating your business. Then you can pay lower tax rate. In Alberta, it's only 11%, and then you can keep the rest of the money in the business and let it grow. So it's important to understand that incorporating a business is not a tax avoidance technique, it's tax deferral technique. So putting it simply, that if you're incorporating and you're taking money out of the business as either dividends or T4 income, the tax rate is exactly the same as if you haven't even incorporated. So it doesn't make any difference. It only times that it helps if you have plans to leave the money that your business is making into the business and let it grow. So if you're concerned about, I make too much money and how can I save on taxes? Everybody wants to pay less taxes, and I'm all for it. If there are legal ways for you to save on taxes, I'm all for it. But before you start thinking of incorporating, you're making too much money and you have RSP room, use that first, because that will help you with the retirement too. So don't start thinking of incorporating right away. If you have the RSP room, use that first, then start thinking about incorporating. So we have talked about the reason why to incorporate. Let's talk about the reason why not to incorporate. If it's a simple business, a lot of my friends, they are, in trucking industry, in construction industry, where they think that they can claim a lot of things which aren't practical. For example, if you are a subcontractor working on construction industry, and so yes, you can claim your gas, to an extent. You can claim your mileage to an extent. You can claim the tools that you're using. You can claim some of the meals, not all the meals, some of the meals. But if you're gonna start claiming, if you think that you're gonna start claiming the grocery that you're purchasing for your family, you can't, and you shouldn't be allowed to claim, because everybody who's paying taxes on T4 income have to pay that for that grocery out of their personal pockets. So why do you feel that you should be able to claim the grocery? So you can claim all the expenses that are related to your business that you have used to make that money, but anything over and above will be disallowed by CRA. So if a simple business, you're the only one running it, you have no employees, and the expenses that you can really think of, if I'm working from home, working on my computer, there aren't many things that I can claim. I'm not going to start claiming my gas or start claiming my mileage, because I don't have to drive anywhere. If I'm working from home from my computer, then I can't claim all those things. I can't claim meals, because all my clients are in Toronto. So think about it, see if they make sense to you. This is one of the biggest disadvantages of incorporating. If you have a brand new business that hasn't been proven to make any money, most of the businesses, the majority of the business in the initial years, they lose money. So if you have an incorporation that you're running your business under and it's losing money, you're claiming losses on your tax returns, but those losses does not give you any advantage. You can leave them on your tax returns and they will be used when the business will start making money. But let's say if the business never makes money, then those losses continue to get piled on, get bigger and bigger and bigger. But if you haven't incorporated and you're using your business income on your personal tax return, those losses can be claimed against your personal income. So this is one of the biggest disadvantages of incorporating. Next one, the cost too high. The initial cost of getting a lawyer, if you want to get a lawyer, and if you want to do it online yourself, the cost can run up to anywhere between $2,000 and $3,000, depending on what other things, get a shareholder loan agreement from the lawyers. Those things can be pretty expensive. You have to remember that you have to file annual returns with Incorporation Canada. I think the cost is $150, maybe $100 every year. Corporate tax returns, you'll have to take you can do this yourself, definitely, but most of the people choose to go to the accountants, like myself, and the cost is anywhere between $1,500 to $2,000. There's other administrative burden, and you have to make sure the records are clean. If you're filing GST has to be filed. Most of the businesses are quarterly, yearly, monthly. And if you don't file them on time, there are penalties, interest, and so there are a lot of administrative burden. So if you still have more questions, please put them in the comment area. I will try my best to answer all the questions. If you like the video, please like my video, hit the subscribe button. Thank you so much.